Hello, my name is Dr. George Mochocki, and welcome to Finance 225. Today we'll be discussing, we're going to be doing Chapter 9, Forecasting Exchange Rate. That's important because remember, when do I bring currency back into the parent MNC, or when do I leave currency there, or when do I pay for my bills, and which denomination do I want to utilize? Which one will minimize my overall costs? Utilizing it. You know, if I know that the currency euro is going to go up, then I want to buy more now while it's down. So then later on I have a more purchasing power. But if I want to bring it back in, I may want to keep it at a lower because of inflation or something else. So I may want to or buy it at a higher price, and then later on. So I look like I have more of a profitability on my annual report. Remember, I'm a chief financial officer, trying to make everything look well, but still trying to look like I am still in control of the situation out there. Okay, so what are we going to talk about? So we're going to talk about this forecasting exchange rate. We're going to look about the different types of forecasting. Remember, I did in purple. So I got a few websites in here: technical forecasting, fundamental forecasting, market-based forecasting. We'll talk about. Just give me a quick little overview here. Mixed forecasting, guidelines for implementing forecasting, and then there's always some kind of forecasting error. No matter what you do, any kind of forecast is something like even though they're doing the presidential race, Donald Trump's up, he's down, and they're doing some kind of a survey, and there's some confidence level. Same thing with forecasting. You're not like it'd be nice if I had a time machine and they may be down in the future. I could go in the future and see what's going on and come back. It's my forecast. I know this is going to happen. Boom. I will make a killing. Would that be inside trading or future trading? I'm just kidding. Okay. All right. So we have that graphic evaluation, comparison, and forecasting in the market efficiency, and using interval forecasting, which basically is looking at methods of forecasting exchange rate volatility. Okay. All right. And then we'll have a summary. All right. So let's get into this right away. Remember, you read the book. The author gives excellent examples. I can't go through every example, so you can read the book, you can print out these mind maps. You're the second tier, you can put in your own words, and now this is at the end. We discussed this in class. We did some homework problems, some examples. I got, I think, a couple of YouTubes I try to pick out from other individuals to make it simple. I may not play the whole YouTube in here, but the link will be there, and it'll be link always will be in Blackboard Course Management System. Remember, you're taking me this as a community college. This is a foundation to understanding international finance. You already had regular finances. Some of these terms we already covered. Now you're just going to take the same information, buying stocks, bonds, investments, or whatever you're doing. Or in this case, bringing currency in, or keeping currency, even though at what bank and when I'm bringing it in, depending on the exchange rate. And again, when we talked about the PPE, purchasing power. The purchasing power priority, parity. What we're looking at that is basically inflation. This one here looking at the interest rate, and the interest rate is kind of in some of them the technical foundational forecasting. It's already going to look at if it's strong economy, is that information already included into the calculation when you're looking at it, or is it or do you have to include it? All right, so let's look at the web. So anyway, you need this because you remember, and then one thing you have to look at when you read the book and everything else. Remember, you're looking at everything else is learning. I'm not going to. You're going to be doing homework problems, the math problems, the equations, some of them are in here, but the exams are going to be just basically on concepts and vocabulary. At this level, when you take this at a bachelor's level or you take this at a master's level, then you're going to go into more of the mathematical aspect of it. Right now, you're just learning a whole new language. There's so many new vocabulary. We're already in chapter 9, and I think we already covered like about 350 new vocab that you should be aware of. So right now, if you just understand the rationale and the strategy, I'll be very happy. And so now what you're looking at this is you already read the chapter. We discussed it. This is a summarization, and we're going to discuss it. I'm just going to go real quickly. Stop me. I'm going to show you the chart. You should have the chart ready in Blackboard or utilize the book. Remember, if you're just picking this on YouTube, it won't make much sense to you unless you already read the material, looked at the book, the example, and this is just a quick review of the main thing. Stop it, look at it, think what I just said, and then go back and figure it out in your mind by the chart. I can't go through everything on here because there's no way I'll finish it in an hour. Alright, so let's look at the web. Remember, the web always wants to go. We've got a couple of good ones, and some of these webs we've already been in here. And in this one here, it looks at quotes on currency futures can create market-based forecasting. So I'm always going to click on the web, seeing all they work, and you have in here, and and it's got trading, you got information, you got clearing, you got regulation, you got data. Okay, that education, and some, all educational material, simulated training. If you really want to get into more of this, usually it's kind of hard, and sometimes I might utilize this. So the author has something we could do simulated training, and we could try something like that. But try it on yourself. Look at the video library. You could go click in here and look at some videos if I'm not making sense here, and gives you the example. That's why I pick up some of these videos. Some of them are a little bit questionable, but they come right to the point, real simplistic. Now I understand it. Then I could utilize the terminology that comes in here. Okay? Alright, so we've got that one. The next one here is, I'm looking at this one, forward rates for British pound, Canadian, Japanese, of yen for 1, 2, 3, 6, or 12 months. And just a link in here. Again, I always throw on the link so you can look at it. It has the fixed rates, what's new, publications, focus on facts, good monthly calendar. Okay, video forecast. Will the aging population corral Canada's household debt? Good question. 4 myths about Canadians. Plunging oil prices won't derail. Will rising prices derail U.S. market? What are our forecasts? United States. All topics, profile. Okay, so you have a lot of information. What I'm saying is, look at the sites. Play with it, go in there, you got nothing else to do, you're tired, look at it, and see if it comes in. If you're taking me in a face-to-face class, part of our discussion in the classroom, everyone will be taking one of these sites, and you can find out what you found out and what you found interesting out of this site. So look at it now, okay? Alright, so we close that site up. Remember, the next site we'll look at this one's going to be the Fed site, implied validities of major currencies. How unstable the currency are, can be used to measure the market expectations of a specific currency. Okay, so now this next one we have volatility can be measured, the market expectations, specific currency volatility in the future. So this one is the Federal Reserve. Let me see. Sorry, let me just click on that one. Okay, so it has everything else: volatility rates, implied volatility rates of average, mid levels, information. Look at it at your own leisure. Makes sense. Look, once you start looking, it'll be easy. All right, to look at that. About the New York Fed. Okay, we've been on this site before, and the last one in here is the what did I have in here? I think this was my video, if I'm mistaken. Volatility. No. Something happened here. Alright, I have to look at it different. Alright, we'll have that in there, but we're doing good. Okay, so now, you got the links. Look at the links, leave it out there, stop it, cut it. If you go into Blackboard Course Management System, I have the links already created there. Just click on there, or in the classroom we'll discuss them. Okay, so they took care of this. Why do firms forecast exchange rates? Remember, I got everything in purple. So all of these we're going to be talking about the exchange rates. I think there's like 5 topics. But then we're going to do it about the bias. Just no way around it. Any kind of forecasting, you're going to have some bias. Sometimes it works, sometimes you don't. That's why I always say you always have to have also that utilize different kind of theories, different kind of forecasting methods, and you use a mixture. And now you have that, and plus you're intuitive, and in God we trust that you have the right discernment and you make the right moves. In most cases, after historical, and after a while, you'll see people who are doing this. Remember, you're not a speculator that's out there just for the rush. You're trying to, over time, to find that level playing field. So you're not making money. I mean, you're not losing money, but you're making a little bit of money, but you're not losing money. In the market, the volatility of the market depends, how active it is sometimes hard to predict. Okay, so why do firms forecast exchange rates? Very good. Let's look at this. Remember, open up your concept maps. I got them different colors. Hedging decisions. Okay, whether a firm, let me just make this just a little bit bigger here. Zoom in. Hang on a second. Yeah, let's do 200. All right. Hedging decisions, whether a firm hedges, may be determined by its forecast of foreign currency values. I got to know it. Do I hedge it? And hedging is basically just to protect myself in case, from my highs and low peaks. So I'm trying to find that cushion, for lack of better, like a common denominator that kind of like levels it out over time. Okay, now short-term investment, so I'm looking for hedging decision. It's one of them. Why forecast makes sense. Something's going on with the currency. Short-term investment, and in this one, corporations sometimes it's a substantial amount of capital. And for a short period of time, maybe I can make some money off of this. Short-term investment, and it's still safe. Remember, I'm not a speculator. I'm a multinational organization just trying to look at another stream of revenue coming in there. If I get a little extra, that could be my bonus for my individual. That could be for me open up another operation, as we're talking about, or utilize for some capital decision making. Large deposits can be established in several currencies. Okay, now capital budgeting is another one. Why I'm forecasting. I know I'm going to have to do something in capital budgeting. So the MNC, multinational corporations, parents assess whether to invest funds in a project, a foreign project, or to take into account that the project may periodically require exchange of currency. So I know this, I got to have inflows and exflows with this project, so I'm already basically forecasting on the exchange rates, so make sure I have the right denomination of currency at the right time to pay off my construction or my capital budgeting investment that I'm required to do. Okay, now earning assessment. The next one is parents' decision. When I look at parents, it's a multinational, it's a home base. I got subsidiaries out there, about whether a foreign subsidiary should reinvest its earnings. Do I keep the earnings in the foreign country or bring it back to the parent to be influenced by exchange rate forecasting? When do I bring the money out? When do I do it? When do I do it? When is the best time? Depending on the strategy that I am doing. Am I importing or exporting? What's my strategy? Am I just trying to survive? What's my strategy? All this is depending on the strategy, and it's just why the forecast makes sense. Because it's something like if I'm looking, if I know I got so much money coming in, but for some reason they're going to say we're going to be closed down for the next 2 months, we're not going to get any money. Holy mackerel, I'm expecting that cash. Well, how am I going to do it? Same thing with forecasting the exchange rate. At what rate is it? When was it to my advantage to either minimize my exposure or minimize my expense or maximize my profitability? Okay, so now long-term financing. MNCs that issue bonds to secure long-term funds may want to consider denominating the bonds in the foreign currency. Okay, long-term, where does it make sense to keep that money? Where does it have a potential of growth? Remember, forecasting. Again, I don't have that crystal ball. I don't have the time machine going into the future. I'm looking at historical data. I'm looking at different techniques we're going to be talking about. And I'm using a variety of these and say, okay, and then plus my feeling saying, I think this is going to be. Majority of the time I'm on there. It's a lot of times about 90%. I'm pretty good, but the 10% I could be off. Hopefully it's off that I have an adverse profitability coming in there. Okay, exhibits corporate motives for forecasting rates. And here basically it just tells you, it just gives you the flow chart. Comes in here, cash flow. I want cash flow up, to go up, or I don't want to cost of capital. I don't want to reduce it. And the bottom line is, remember the whole thing we're learning about this whole chapter from MNC is to keep the parent organization of value to increase the value of the company as a whole. So the subsidiary has to maximize their profitability or the profit center, for lack of better words, but the whole thing is to maximize the value. So I may be down here, up here, but overall I'm either stable or I'm showing a profitability depending on my strategy. Is it growth strategy or is it a new product coming in? Okay. All right, so we have that. And the next one, let's go into the forecasting techniques. And this one's just going to tell, just four of them, we're going to have them in here. I just show you for those who want to, when you're studying, if you have a question, what are the four forecasting techniques? You got technical forecasting, fundamental forecasting, you have market-based forecasting, and this is based between this one and the mixed forecasting are the ones that you would most commonly utilized, and it says see following slides. Okay, so let's look at the technical forecasting. It involves the use of historical exchange rate data. Why historical? Because to predict future values. That's the closest thing I'm going to get is my exchange rate historical. Here's what's going on. But remember, I always have to look when I look at historical. Here's the exchange rate. I have to know all those other factors that's influencing that. Okay, limitations of technical forecasting. Oh, I got a limitation. Focuses on near future, very near. Can't go out too far because it's a historic. I'm looking at the trends, and I mean, a lot of things could be happening now that didn't happen 5 years ago or 2 years ago or maybe a year ago. Always what your baseline is. It rarely provides pointed estimates or range possible future values. Rarely provides that. Technical forecasting models that work well in one period may not work well in another period. And we talked about that. Depends on what's going on there in that thing. And a lot of times they say we're in a recession. This was like the Great Depression. Was it? Here's the same thing. But no, but these we had these factors, but we also had this. We didn't have this, and this is the way it was set up. So they're trying to justify one way or the other. It still felt like you're in a depression. Things were hard. People are unemployed, but things happen. Okay, now fundamental forecasting. So you got the technicals, looking at historical data. So remember, you just highlight that. Remember, trying to highlight what you want. Don't do all this. Just highlight the keywords, what's important for you. You read it, you talked about it, you did some homework problems, and now highlight this, what you need. Okay, now fundamental forecasting. Okay, I got a green flag. These are good. Based on what? Fundamental. Fundamental relationships between economic variables and the exchange rate. What other variables happen? The inflation. What unemployment? What other economic variables were out there? And what was the relationship between the exchange rates? That's the fundamental forecasting. Use of sensitivity analysis or fundamental forecasting. Remember the software on this. Don't go, oh my God, I got to remember all this. Don't get software that already has a math problem, but we're here. You just want to understand conceptual. Considers more than one possible outcome. There's always a B. You're forecasting. You're going to meet a tall, dark, handsome person, or tall, dark, handsome woman, or you're going to meet a tall, blonde woman or redhead. You have different options. But the high probability to be tall and dark. Why? I'm going to Italy, and Italy most likely most people got darker complexion, darker hair. I'm going to the United States because Scandinavia, I have a higher probability of more of a blonde. I'm just making that up just so you can see the rationale. It's not that hard. Okay, just more than one outcome. You're just doing your best one, and you're looking at a probability. That there's a system of saying if all these variables are constant, so here's a probability that this will be the outcome. Okay, now use of PPP is, purchasing power parity is utilized when inflation. So you're looking at this. Was this one of the economic factors? While the inflation rate differential by itself is not sufficient to accurately forecast exchange rate movements, it should include it should be included in the fundamental forecasting model. Okay. Stop it, look at it, write it down. What is he saying? And then I'll think it through. Okay, limitation of the fundamental forecasting include, here's some limitation, unknown timing of the impact of some factors, something happens, economic or governmental forces, something else. Forecast some factors may be difficult to obtain, depends on the country. Try to find something else. Let's say North Korea. I'm just using it as the most extreme. You don't really know what's going on. We could assume, but But a lot of theirs are very protective. Okay, some factors are not easily quantified, and regression coefficients may not remain consistent. When you look at statistical, is going to have some flaws in it. We'll talk about a little bit later on. Some bias that normally fall into all of these. Okay, now market-based forecasting. Now this is the one is using spot rate. Now why do I use the spot rate? Today's spot rate may be used as a forecast to spot rate that will exist in a future date. This spot rate is as close as you can remember. We're not going real long. We're only going in a short term future. So my spot rate, I could usually say, is it going down or is it kind of going up? Depends on the graph that you're looking at. Using a forward rate, if I look at the forward rate to forecast future spot rates, and here it is, expected percentage change in the rate, which the forward rate F exceeds the spot rate S. You'll divide it minus 1. Okay, there you have it. So you got the formula. stop it. If you don't have the formula, write it down, look at it, see what's going on. The book has the formula and example that walks you through, and then you could just plug the numbers, and then you could see it. All right. Remember, the book is your main resources. This is a supplemental after it's done to what you should have already picked up. Oh, I understand this. No, I got some issues on here. Go back, read it. Or I've got some linkage for different YouTube, different authors, different individuals putting it in their own word as to bring it some creativity into the class. And remember, finance is sometimes accounting is dry. Finance a lot of times shouldn't be dry, but when you're looking at the basics, you have to understand it. Okay, rationale for using the forward rate, reasonable forecasts for the future spot rate. Otherwise, speculators would trade forward contracts, forward contracts or forward future contracts, same thing. Something a forward future is used interchangeably. Don't get confused. Oh, I got two more words, same words. It means a future forward contract and a forward, or a future contract, something in the future. To capitalize on the difference between the forward rate, what's the forward rate, because it's locked in. You know, what's my spot rate now, currently? What's my forward rate? What do I assume my forward rate is going to be forward? Expected future spot rate, okay? So here's what I do. Would I hedge it? Would I expect it? Remember, these are all you're doing. And remember, your whole thing, that we've talked about, the whole thing is building a relationship with the unit, that you have the money, the right amount of money at the right time. If I got a CD at home, I'm building something, and I know it's an annualization, going to annualize over time. You know what I mean? So what's going to happen? I put in so much at 20%. You know, by the time I'm ready, or like a bond, I save a bond, I'm ready to cash in the bond, I'll have the full amount. You look at U.S. Treasury amount. You know, I buy it for $20, but it's a $30 one over so long. When I'm ready to buy it, I'll have the $30. That's what you're trying to do with the exchange rate. You're trying to make sure that you're thinking what's going to be in the future. So you locked it in. You got some kind of protection. But how much? But you think it's going to be dropping because something's happening in the environment. Money's cheap. So now how do I do it? I try to do some hedging. You're not to make money. Sometimes you do happen. You don't want to lose abnormal loss, abnormal profits, okay, but you can't do that all the time. You want to always be steady. So I just have just enough. It's like I pay just enough taxes that the year end I'm going to get all this money back, but I haven't made anything out of it because I gave the government interest free. I just want to break even, give the government maybe $5 I owe them. I'm so close. That's what the chief financial officer is supposed to do. How closely do I do it to break even? Do I hedge it? You know what I mean? Do I buy it, forward contract? Do I bid? Do I sell? All this information, my strategy. How do I do it to make it so I'm not losing money, making a little bit of profit, but I have the right amount when I need it at the right time, the currency. Okay, so long-term forecasting can be derived from a long-term forward rates. The forward rates is typically more accurate when forecasting exchange rates for short-term horizon. Right? It's more accurate for short, but it's not very accurate for long-term because it could change very abruptly. Volatility of the market. Okay, implementation of the International Fisher Effect forecast. Okay, International Fisher is looking at interest rate. Remember, the PP is always looking at inflation. The two, you have to know the difference. You know, how much is the dollar worth now? You know, inflation. What I could buy for a dollar now because inflation. Any more dollars? Okay. Okay, so international Fisher rate, forward rate captures the interest rate differential and therefore the expected inflation rate differential. Should provide a more accurate forecast for currency. Right? I get the thumbs up in high inflation currencies than the spot market. Because the spot market is now, but it might not tell me what the inflation is out there. I'm just looking at what the market is, and I realize that the peso, the currency, is overinflated, so it's devalued by more than I was expecting. So I can't use the same, I don't have the same purchasing power as I would parity as I thought I would. Okay, so we already had this one, market. Yeah, this one's pretty good. It gives me everything else in here. Remember, the market is after a while, if it's on there, if everyone understands the market, then all of a sudden you make the adjustments, so everyone's playing the same field. You don't have that edge anymore. So, but it's out there. The one that a lot of people that you'd utilize is a mixed forecasting. Mixed combination of forecasting techniques, figure 9.2, and here's technical. So just talking to the different forecasting will continue to fall. Read the fundamental economic growth and inflation interest rates, right? Factors are considered, market-based, spot rate, forward rate, right? Remember, once it's market, exhibits significant discount, which attributed to Mexico's relatively high interest rates. Okay, so when I look at this, look at that, and just give you some forecasts. And then when I'm looking at, it's a weighted average, and you're the one again figuring out what average is. Weighted average. I mean, it's going to be always 20% of this is going to affect me, or 30%, and that's something that you have to come in. That's where you're intuitive. That's when what average or weighted average you put in on the different what do you call it techniques. Which one you're utilizing when you're mixing it. Which one do you feel more comfortable? Which one historically has a more accurate predictions with you? And that's something you have to do on your own. What you're looking for, and depending on the strategy that you're trying to accomplish. Okay. So now some guidelines for implementing the forecasting. Okay, one real easy. Sorry, let me play back in here. Apply the forecast consistently with the multinational corporation across all of them, all your subsidiaries. Measure the impact of alternative forecasts. You have to always have what-if options, the software that does that for you. SPC. Let's see, consider other sources of forecasting. Always have to consider it. There's more out there. Sometimes you may even go with outsource it to see as a check and balance. Okay, now let's look at forecasting errors. Any kind of forecasting, there's going to be some confidence issue with any kind of forecasting. I'm just doing a forecasting. That's my best assumption going forward. Some are better than others. If I always knew what's going forward, I'd be 100% right. I'd be a very wealthy individual. Not the case. Okay, so we're into forecasting errors. So when I'm looking at forecasting errors, what kind of errors do we have here? You have measurement of forecast error, and I got the equation here. Absolute forecast error is the percentage of the realized error. Forecast is a value minus the realized value divided by the realized value. Forecast errors among time horizons. Okay. Potential forecast error for a particular currency depends on the forecast horizons. Okay. Now the next one is forecast error over time period, just over horizon. Forecast error for a given currency changes over time. That makes sense. Over time, something's happening with different factors. Just a reminder, okay? Forecast accuracy among currency, and it says ability to forecast currency values may vary with currency of concerns, and here they have different currencies, and you can have the volatility of the currencies, okay, and the forecast and the percentage, and different ones, okay, vary the currency of concerns, all right? Now, forecast bias. Again, part of the errors, forecast bias, when I'm looking at it. When a forecast error is measured as a forecast value, here's an error, I measured it wrong, minus the realized value. Negative errors indicate underestimating. Don't get me wrong, I underestimated it. That's where I made more money, but if I underestimated, I lost money higher than I thought that wasn't anticipated. Okay? While positive errors indicate overestimating. Now, sometimes you wonder, are they done purposely or not? Let's just leave it at that. But just look at it, you're right? Positive errors indicates overestimated. Negative errors indicate underestimated. Statistical test of forecast bias. Conventional method of testing for forecast bias is to apply following regressions model. Let me just highlight this for you. Okay, so when you do it, remember, that's what I would highlight with yellow. A regression model to historical data. Okay, and what's the regression model? And if I had the regression model, I'd click it on here. Here's my regression model. You could put it in your scientific calculator, already has it, and you'll be able to put it in your spot rate, the forward rate, the error term, the intercept, okay, and then the regression coefficient. All right, put it in there, boom, 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 and hit complete, and you'll be done fine. And there is an example in the book, and he walks through the example and step by step. So stop this. Remember, print this out. And a lot of times, if you're also doing this on the YouTube or anything else, or in the Harper University IU, that this is available to myself or other instructors, you could stop it there, and you could just click stop the thing and just hit screen print. I've got it large enough here, and you'll be able to take this and then have that way. Or if you utilize the author's site, he has the information there. You go to his site, you purchase a book and everything else, go to his site, you have the information. Or you got the videos also. You could utilize that on there. Okay? Okay. Now, the graphic evaluation or forecast performance. Again, I just made a little difference, so it's not all in the one. Fills in easier for you. Just still looking at the graphical version of a forecast. Now, I've got different graphs here, but forecast bias can be examined with the use of graph that compares forecast values. Remember, graph visual is easier to see. When realized, a computer could do it for you also and give you this the number. A lot of times, anything to a computer, there's a lot of programs on there. You have it, you hit it, and then basically it'll give you it in the graphical form for a visual. It's easier to see. Okay, realized values for various times and periods. Okay, so I'm going to just go hit. Here's the different times. You look at it here. Here's when it's graphed in here. All right, shifts and forecast graph. Just stop it, slide it over, and then you hit pause on your thing on here, stop it and look at it, or open the book and look at it and see where the numbers are going. What's it telling me, and does it make sense what I'm stating in here? Okay, so how many do I have? I got 2 slides. All right. Okay, and then shifts in forecast bias over time. The forecast bias can change over time. We know that. At times, it could change overnight, for lack of a better word. Refining a forecast to adjust for forecast bias. If something's changing, you should have your forecast. There should be a living forecast. You're always adjusting. It's your best target. At this time, I'm looking at this in my dashboard. Here's what I did, and next time. 5 hours later, oh my God, I made a mistake, but I'm looking at it. Is it just a glitch or something going on there? Or do I move the money faster? Remember, time is an essence. Okay, redefining for adjust a bias. Detect in the past is not a perfect. Detected in the past is not a perfect solution. Just because it happened before doesn't mean it's going to happen now. Okay, now comparison. Okay, an MNC can compare forecasting methods by plotting the points relating to 2 methods on a graph. Similar. So you're plotting the 2 methods on the graph, okay? And then by comparing the distance of points at a 45 degree, and here I got some cases, neither forecasting method may stand out as superior when compared graphically. Because you can't see it. In a graphic, I look at it, in a chart like this, I got the numbers will tell me real quickly. But otherwise, if I didn't have this, I may be able to see it in the graph. I could see which way it's going. It's easier for me to see it visually. All right. Okay, so I got that one. Did I have that one? Okay, very good. All right, now, forecasting under market efficiency. Weak form efficiency. When I have a weak form efficiency, historical and current exchange rate information is already reflected in today's exchange rate and is not useful for forecasting. So I don't know what number they did, but it's in there. It may not be useful because it's going to be, it's already adjusted, okay? Now, semi-growth form efficiency, all relevant public information is already reflected in today's exchange rate. Okay, this one's historical and current exchange rate information is reflected. Okay, now strong form efficiency, all relevant public and private information is already all public and private. See, stronger, we reflect in today's exchange rate, and YouTube of reach settlement. Now I'm going to put this one in here. Now this is one I like using in some when I in a finance class, but let me put it on here.
Now let's go back to the first example of Greedy Bob and Bill, where Bob learned about the good news first, and then he told only his buddy Bill, and then
there's NBA
Bill buys the stock.
He's all right.
Bob announces it to the public.
He makes it real simple.
In this first example, okay, where the information did not flow freely and easily.
So it's not efficient. Okay.
Over here, which is what we had.
All right, I'm going to stop that in there. You can look at the YouTube.
This is strong market efficiency. Everyone learned. Now let's go back to the first example.
All right. All right. Yeah, remember to turn it off. Okay, so we have that. Now the last one we're going to use interval forecasting. So we have that. So remember, when you have forecasting efficiency, you have the methods, you have certain errors. There is going to be some bias. There's no way around it, and that's why there's no real relevant theory. You have to use a multiple. Which ones you feel more comfortable on? Which ones are more predictable for your own financial strategy that you're looking at, and what you feel comfortable in interpreting the numbers to your own intuitive learning process. Okay? Alright, so let me close this up. Okay, now let's close this up. Okay, let's see, using intervals. Okay, methods for forecasting exchange rate validity. Alright, used to forecast the future. Okay, are we doing good? Okay, so methods for forecasting exchange volatility used to forecast the future, using recent levels of volatility of historical exchange rate movements over a recent period can be used to forecast the future. Historical patterns of volatilities. If there's a pattern to the changes in exchange rate volatility over time, the series of time periods may be used to forecast volatility in the next period. All right, you're looking for a pattern, an exchange rate, volatility over time, over a series, be used in the next period. Using implied standard deviation, derived implied ISD from currency option pricing. Again, your statistical calculator, just plug it in, you'll be fine. All right. What's my standard of deviation? Okay. Now, when I have that. So remember, these are using interval forecasting, exchange rate volatility, historical patterns that has some limits, and implied standard deviation. And then what you're going to find out, there's no 100% correct. Depends on the period, depends what's going to happen, depends about different factors, economic factors, governmental factors. And so you use a mixture of these, and there is some bias, and you I'm going to say keep your fingers crossed, but most of the time you're pretty accurate on that. Once in a while you're going to make a mistake. Hopefully it's not a big mistake. All right, otherwise you'll be out of a position. Okay, now let's do some summary. We're going to talk about multinational corporation need for exchange rate forecasting, most common forecasting techniques. Each technique has limitation and forecasting methods to evaluate. This is our summarization. Sometimes I'm going to try to go from the beginning, but let's summarize. To make decisions on hedging, payables, and receivables, short-term, right, multi-corporation needs exchange rate forecasting for one, to make decisions on hedging, payables, and receivables. I need that to make sure I have the right amount of money in the right denomination. Remember, I'm a multinational. I'm doing different countries, different currencies. Currency is just like another a commodity, a supply. You got to have so much currency, and it depends what's the value of the currency. Bartering, what's the value? If this commodity is higher, can I make some money off of it? If I don't need all of it, can I still make some money by selling it? Or do I need this and I hedge ahead of time to keep the prices locked? But I see something going on, so do I get rid of it? It's all of this, okay? And then I need this for my short-term financing investment. I can make some money in the short term to pay off another expenses or bonus. Capital budgeting. I'm doing this money. I'm building something. Make sure the money's there at that money at the lower rate, and hopefully it's going to appreciate the exchange rate. Forward contract or future contract in the future. What I mean, not depreciate. So I don't want to pay a premium. I want to get the discounts. All right. And then long-term premium, when you're looking at premium, it's me, I'm paying a premium, my insurance premium, my premium, I'm paying something. Discounts means I'm getting something off. Okay, long-term financing, right? For the long term, I have to do it. Most common forecasting techniques, and we talked about them, technical, fundamental, market, and mix is basically this. When the market works out well at the beginning, but once everyone in the market already is adjusted to it, then you no longer have the advantage because you're all playing by the same thing. So you have to do some difference. You do either, the technical historical data, give or take. I would go more to fundamental and the marketing. Those two together, and you could always mix them around. What we could do, we're talking about the weighted average. So which one you get a weighted average, so it has that balance. It's like, but it depends on you and your strategy and your organization, and your break-even point or your profitability. Hopefully, not the negativity. You know, you're a speculator. There's something different. Each technique has its limitation. You know, the quality of forecast produced varies. Exchange rates are difficult to forecast accurately, depends what's going on with that currency, because their movements can be volatile over time. You know, volatile over time. Okay, forecasting methods can be evaluated by comparing the actual values of a currency, you know, to the values predicted in the forecast model. Here's comparing my actual values, and here's what my model predicted. How much was I off, and make the adjustment. Remember, I'm still doing the thing and making my maybe a little bit more. You're kind of always tweaking it a little bit, but don't go too extreme, because you don't really know unless you think it's going to be a big extreme. Something's going to really happen. To be meaningful, all right. And then this comparison should be conducted over several periods. And if I'm looking at what's going on in the stock market in China, and that's what's driving the stockholders and the financial market crazy, because China's trying to either crop it up, it's doing something, so it's putting some confidence and no confidence, and then people are going, how much are they going to be really be meddling in that it's going to be a free market, or they're going to just control how much they're going to make. And that may be just a good strategy too. Okay, so they control 5%. Okay, it's more than I'm making here, so I may keep it in there. But you still have to look at, do you want that control, or will you reduce it? So, okay, so to be meaningful, this comparison should be conducted over several periods to see if you have some kind of historical trend. 2 criteria used to evaluate performance of a forecast methods are accuracy and then bias. And bias we have in here, there are different biases, so you have to be aware of it. The more the accuracies, when comparing accuracy of forecasts for 2 countries, the absolute forecast error should be divided by the realized value of the currency, the real currency, in order to control the differences in the currency's relative value. All right, so that's our summary, and we have everything else in here. I think we did pretty good this time. Put this in here. Hang on a second. All right. Now view. Put this at 150. All right. Now I'm finished. Okay. My name is Dr. George Mochocki, and I hope this helped you some. Remember, read the book. Go to the class and do the homework. Stop my recording, look at it, look at the videos, look at the examples, try to understand in your mind, and try to go forward. Remember, there's a lot of information. We're going to be going to the next chapter. You know, we're doing like 1 chapter a week. There's a lot of information. Are you going to be an expert? No way in heck. Are you going to remember? Hopefully you remember 60% of this, and hopefully the main key concepts you'll remember. You know, exchange rates. You already know when I take the PP, purchasing power parity. I'm talking about the inflation rate. When I'm talking about the exchange rates, I'm looking at the interest rates, for lack of better words. What's the exchange rate of my currency? I need those combinations. I need to understand the factors, and you know, I need to forecast. There's no real way to forecast, but I know the bills are coming. I know here's what's needed. I'm trying to have just enough money, but let the money grow on its own. You know, I want to have the money work for me as a financial officer, or anyone in finance, especially when a multinational corporation. They have money all over, and remember, they're not out there to make it rich. They're looking more at the relationship, that the right amount is there, the right currency. They're helping that country out. They get favorable laws passed in their favor. They get favorable status. They get favorable breaks. They get there's a lot of thing in there when I look at social responsibility and everything else that you're looking at it. You know, because corporation, multinational, they do have their input indirectly. You know, I mean, just like governments, how they play with the exchange rate. All right, so you're taking this class at a community college, either an online or face-to-face class. If not, sign up. Harper College has a lot of classes, or your local community college has this course. It's a good, solid foundation for you to understand, and it's nice, even as you're going for your bachelor's, to have some international business classes going, because we're operating in a global environment. And I'll see you in the next chapter. Bye.